Good afternoon, ladies and gentlemen. Welcome to the Liberty Call for Thursday, January 27th, 2022. I hope everyone is having a fantastic Thursday out there. It's pretty snowy and gloomy here in Colorado. Had to run out and do a little blood work for my physical today, so that was a lot of fun. We were only supposed to get, maybe 1 or 2 inches of snow, and we haven't gotten a lot, but when you're I live out in the middle of nowhere, and driving to town is when there's no road. It's just white everywhere. It's you're having to drive between the little posts on the sides of the county roads where I live. So it's a lot of fun. So it's a good thing I drive a tank. I did slide a few times. Unfortunately, coming on my way back here to the house, after being at my appointment, getting back to the freeway and to head south on 25, and there's car in the northbound lane rolled over in the snow on the side of the road, blocking up. And of course, they block off the entire freeway south of Denver. So anyone trying to get from Springs up to Denver was trapped. And I saw another note that down near Colorado Springs, probably about 50, 60 miles south of us, they completely shut down the northbound lanes of 25. So for anyone out there who might be listening who lives in the Colorado area, be careful. It is, while it's not a lot of snow, it is very, very slippery out there today. I think the temperatures are only in the mid to low 20s. So, yeah, ground freezes pretty fast. All right. Well, for those of y'all who live in more temperate climates, let's go ahead and get into what's going on in the markets today. Another one of those roller coaster rides. It was, the market was up, the market was down, just back and forth most of the day. The Dow Jones closed down 0.02% to 34,160. The S&P 500 was down 0.54%, closing at 4326. NASDAQ was down 1.4%, closing at 13,352. Small caps were down 2.25%. The VIX was down 4.6%, closing at 30.49. So that's a good piece of news. I'd like to see that head down towards 20 to feel a little bit better. Otherwise, it leads me to believe that we're headed for more of a downturn than an upswing. So we'll see. Across Europe, mostly almost all green except for the S&P BMV IPC and the OMX S30. I'm not sure what that one is. Across the Asian markets, mostly red. I only see 2 that are in the green. It was the IDX Composite and the Karachi 100. Everything else was down, better than 1%. Some of them 2%. So kind of a mixed day across the globe. Overnight they were down. Early this morning in Europe, things were up. And then here in the United States, it was kind of mixed. So let's take a look at, let me bring open my chart. So you can see how the Dow Jones did today was, up, what was it, up at its highest? Looks like it was up about 600 points at a few times today. And then was down a little bit and then finished basically flat. The only U.S. index I see in the green is the the Dow Jones Utilities. Even though it did pull back, it did stay in the green the rest of the day. The S&P 500, a very similar trend. It was up about 73 points or 1.7%. And again, this afternoon, went into the red, kind of got into the green a smidge, but not too much. The NASDAQ, again, very similar chart, finished underwater for the day. So not ideal from a trading perspective, but, I think we'll have a better idea over the coming weeks on whether or not this is going to be more of a longer term trend. All right, well, let's go ahead and look at some of the economic statistics that came out today. U.S. jobless claims declined for the first time in 4 weeks. Applications for U.S. state employment insurance fell for the first time in 4 weeks, partially unwinding a recent spike in claims due to the Omicron variant. Initial unemployment claims totaled 260,000 in the week ending January 22nd, down 30,000 from the prior period. Labor Department showed on Thursday the median estimate in a Bloomberg survey of economists called for 265,000 applications. Applications declined after a surge in recent weeks amid an uptick in COVID-19 cases across the country. Claims have largely been falling in the past year as companies are desperate to retain and attract talent amid ongoing labor shortages. So that's a piece of good news. We'll look at that in more detail tomorrow when I go through all the different economic numbers. Next bit of information, pending home sales end 2021 on a low note. Home buying in the U.S. slowed in the final month of 2021. Pending home sales, a leading indicator of the health of the housing market, fell for the second straight month in December and was far slower than economists anticipated. The National Association of Realtors pending home sales index, which tracks the number of homes that are under contract to be sold, dropped 3.8% in December from November and declined 6.9% from the same month a year ago. Activity was down across all regions of the U.S. or in the U.S. Analysts expected a 0.4% decrease in sales from the month earlier and a 4% drop from the same month a year ago, according to Bloomberg consensus estimates. Pending home sales faded toward the end of 2021 as a diminished housing supply offered consumers very few options, said Lawrence Yun, NAR's chief economist, in a press statement. Mortgage rates have climbed steadily in the last several weeks, which unfortunately will ultimately push aside marginal buyers. Last week, for the most common mortgage, 30-year fix rose to 3.56% from 3.45%, the highest since March of 2020, according to Freddie Mac. The latest read Thursday morning shows the 30-year mortgage rates are flat at 3.55. Yun forecasts the 30-year fixed mortgage rate to jump to 3.9% by the fourth quarter of this year. The market will likely endure a minor reduction in sales as mortgage rates continue to edge higher. Total housing inventory at the end of December was 910,000 units, down 18% from November and down 14.2% from a year ago, the lowest level since 1999 when the National Association of Realtors started tracking inventory for all housing types. Unsold inventory sits at 1.8 at a 1.8 month supply at the present sales pace, down from 2.1 months in November and 1.9 months in December. Contract signings declined in December as buyers faced the all-time lowest inventory of unsold homes. At the close of 2021, the U.S. housing activity remained unseasonably competitive as buyers bid for a smaller number of homes for sale. In addition, the winter holidays and colder weather encouraged people to take a break from the market. Many homeowners postponed plans to list, leading to further declines in new inventory and pushing listing prices 10% higher than in December of 2020, said George Ratui, manager of economic research at Realtor.com, in a statement prior to the results. Latest home building data point to some relief. According to the Commerce Department, housing starts rose 1.4% to a seasonally adjusted rate of 1.702 million units last month, the highest level since March. December marked a third straight month of increased home construction, according to the NAR, and Yun expects housing inventory to continue to improve and contribute to slower home price growth in 2022. He forecasts housing starts to rise to 1.65 million units. Ratu was not optimistic. These trends are continuing in January 2022, with Realtor.com's latest weekly housing data spotlighting continued competitiveness despite a sharp rise in mortgage rates. Homes hitting the market are selling 10 days faster than a year ago before being snapped up by buyers who are likely concerned about even higher interest rates in the months ahead. At this pace, I expect spring buying seasons to start well before trees begin to sprout new buds. So from a home buying perspective, we're probably going to see home values recede a little bit with the increase in interest rates. Unfortunately, there is a inverse correlation there. As interest rates go up, the upward pressure on home prices will probably recede the other direction, because I think I talked about this the other day. If interest rates go up, that same mortgage balance is going to have a higher payment because of the increased, if your interest rate goes, say, from 3% to 4%, that's going to increase your mortgage payment by, X dollars. So, in a competitive market where people are selling homes to people who have mortgages, most people buy a house based upon what their, mortgage payment is going to be and how that fits into their budget. So, I am expecting, a downtrend in home prices. Obviously that's going to be dependent upon, the market that you're in and the, where you're located. But, all in all, I would expect to see, at least a slowdown, like where I live here in Colorado, it's a pretty competitive area and there's not a lot of houses out here in the middle of nowhere. So, you kind of got to take what you can get. It's kind of how it was 5 years ago when we moved here. Yeah, 5 years ago, and it's just a very competitive system. When there's not a lot of homes, you got to kind of deal with what you got. Now if there's a lot of foreclosures, here in the near future, then the inventory, when there's a lot of inventory, that's going to put some downward pressure on prices. In addition to the interest rates going up. All right, next story. Dollar jumps, stocks mixed as investors eye Fed rate hikes. This is written by Pete Schroeder from Reuters. U.S. stocks painted a mixed picture Thursday as investors digested how strong economic news could inform the Federal Reserve's thinking on interest rate hikes, while the dollar hit its highest level in over a year. After a solid opening, stocks retreated around midday with tech-heavy NASDAQ Composite and S&P 500 dipping into negative territory, dropping 0.65 and 0.16 respectively. The Dow Jones Industrial Average was up 0.12. The International World Index, which tracks shares in 45 countries, was down 0.48. Markets opened optimistically due to new data out Thursday morning showing the U.S. economy accelerated in the fourth quarter, growing 6.9%, fastest rate since 1984. But gains were paired as investors processed how strong economic growth might inform the Fed's thinking after Chair Jerome Powell indicated at a Wednesday news conference that the central bank's primary concern remained inflation. This is clearly good news for the health of the U.S. economy, while it strengthened the case for an aggressive tightening policy from the Federal Reserve, said David Madden, market analyst for Equity Capital. The fact that U.S. stocks are higher despite the solid GDP reading could be a sign that dealers are getting used to the idea that there could easily be 4 or 5 rate hikes this year. Now, if people in the trading markets and in the investment world aren't aware that there's going to be a bunch of interest rate hikes this year, you've been living in a cave. So you might want to get out and read a newspaper or get on the interwebs and maybe peruse a few investing websites. All right. Dollar surges. The prospect of faster or larger U.S. interest rates helped push the dollar to its highest level since July of 2020. In its latest policy update on Wednesday, the Fed indicated it would likely raise interest rates in March, as widely expected, and reaffirmed plans to end its pandemic-era bond purchases that month before launching a significant reduction in its asset holdings. Fed funds rate future showed traders pricing in as many as 5 rate hikes increased by December after previously fully pricing in 4. The dollar index, which measures the greenback against other major currencies, had climbed 0.8% in the day, its biggest single-day gain in more than 2 months. Expectations of Fed tightening sent the policy-sensitive U.S. two-year yield to an intraday high of 1.208%, a level last reached in February of 2020. The two-year yield dipped slightly to 1.1683% in midday trading. So, as we can see, the a strengthening dollar has had some collateral effects on things like commodities. Oil prices have dropped over the last couple of days. Gold and silver, same thing. You've seen a retracement in those commodities. But I think the longer term, looking at the technical charts, I see at least the metals as not dropping into negative territory on its MACD momentum indicator. So for now, I all things considered, I still feel that the commodities market is probably one of your safer bets right now. With the stock market, way overpriced at this time. The bond market's in some turmoil because the bond market is paid out in U.S. dollars. If the dollar were to see a crash, that's going to have a correlative effect to the bond market. All righty. Next article, orange juice heads for longest rally since 1991 on frost risk. So for those orange juice drinkers out there, you may want to stock up because those prices might be going up. Orange juice futures are headed to the longest winning streak in more than 30 years, with frost threatening groves in Florida, the top supplier. The entire citrus country will be at risk of frost this weekend, according to World Weather Inc. President Drew Lerner. At the moment, readings are expected between upper 20s and low 30s, 30 degrees Fahrenheit. Trees must be exposed to temperatures near 28 degrees or below for 4 hours or more to cause major damage. Northern fringes of the citrus belt will be the coldest, said Donald Kinney, meteorologist with Maxard Technologies. The most active March contract jumped as much as 3% to 1.6445 a pound in New York. It's up 4.2% this week. If this price holds, it will be the 8th straight weekly gain and the longest since 1991. Stockpiles have plunged and output is down in other key producing areas besides Florida. California, which produces mostly for the fresh fruit market, is also expected to see a decline this season, as is third-ranked Texas. Overall, U.S. orange production will fall 11% from a year earlier and 25% from 2 years ago. The U.S. can't look to imports to bolster supplies because surging transportation costs have made them so expensive to ship from countries like the top citrus producer of Brazil. There's a chance the frost won't materialize for Florida's groves. The risk is low, and about half the state's total crop has already been harvested. So any losses, if at all, would be small, said Judy Gaines, president of J. Gaines Consulting. The biggest risk would be to early buds for next year's crop. Orange juice demand has risen in the pandemic, partly because it's seen as boosting the immune system. However, if there isn't enough supply, consumers will simply take vitamin C or get vaccines instead, she said. The market is getting ahead of itself, Gaines said, of the rally. In other soft commodities, cocoa, cotton, raw sugar, and Arabica coffee slid, partly under pressure from the surging U.S. dollar that's eroding the appeal of commodities priced in the greenback. The American currency climbed to a new high. Yeah, we just talked about that. So for you orange juice drinkers out there, again, you may want to, it's not something I drink. I don't like to drink sugar. So, if I'm going to get vitamin C, I usually take it in the form of a pill. But I know there's a lot of people out there who like it. I actually like the flavor of orange juice. I just, like I said, I'm just not going to drink it. So I guess I forgot to put that on the screen. So, all righty. One more article here regarding U.S. Well, actually, I got two more. Morgan Stanley sees U.S. debt to GDP ratio down 7 percentage points in 2022. A huge U.S. fiscal deficit from the first 2 years of COVID-19 spending should decline rapidly to near pre-pandemic levels, largely due to a rebound in economic growth. Analysts at Morgan Stanley said on Thursday. In a research note, the investment bank's economists predicted the debt to gross domestic product ratio should decline 7 percentage points in 2022 after reaching the highest level since World War II. During the pandemic, real growth will contribute to about 6 percentage points, and inflation a similar percentage, offset by interest expenses and primary deficit spending. Our expectation for fiscal year 2022 and 2023 are much more moderate, especially after the failure of the large-scale Build Back Better spending program to pass last year. For 2022, we expect the deficit of 4.1% and 4.0% for 2023, closely in line with pre-COVID decade averages. The economist said interest rate levels and net interest expenses are more important in determining the state of public finances than debt to GDP. Interest rates are expected to stay relatively low, even if the Federal Reserve tightening expected to start in March shifts them marginally higher. U.S. Commerce Department said Thursday that the economy notched its strongest growth in nearly 4 decades in 2021 after the government pumped trillions of dollars in COVID relief. The economy grew 5.7% in 2021, the strongest since 1984. The government said in a report showing GDP increased at 6.9% annualized rate in the fourth quarter, following a third quarter's 2.3% pace. Growth is 3.1% above its pre-pandemic level. So, looking at that, we see that analysts are expecting to see the debt to GDP ratio, start to recede. We'll see. That that chart has been going on, on an upswing for the last, several years. I'm, I hope, there's a little bit of hope right there that, something will be done about it. But, I, at this point, I just see things continuing to, skid out of control. All right. One last article here. Inflation, seniors struggle with new era of rapidly rising prices. And this is probably my biggest concern for, if the government falls apart, the dollar crashes, life will go on for most of us. But for those who are, out of the workforce and, on fixed incomes, this is probably my biggest fear. It's like, what's going to happen to these folks? I certainly wouldn't want to, have another government sponsored program to help people out because, we can see what happened with Social Security and Medicare and Medicaid. They just have, pilfered those funds for other things. And, now we're in a really tough pickle. All right. This is written by Carrie Hannon and it was published today. Soaring inflation is troubling for everyone. But when you're retired, it can be a wallop. The national average gas price is up by more than 39% from a year ago, while rents jumped a record 15.7% year over year in December, according to Zillow. And Medicare prescription drug premiums will increase almost 5% this year, according to the Centers for Medicare and Medicaid Services. That's weighing on many seniors, according to the survey by the Senior Citizens League that will be released February 8th. Food costs ranked as the fastest growing cost for retired households, followed by housing and medical costs. About 45% of the 1,750 respondents said they had no retirement savings to augment their Social Security income. So, that's a scary trend. Almost half of retirees have no additional savings or money that they can spend. So, if this inflation does continue for even just another year or two, it's going to put. I don't see deflation on the horizon at any point. So, even if prices after everything normalizes and all the all the prices settle across all the different markets, with all the inflation we've seen, like I said, I just don't see it going back the other direction anytime soon. Many retirees rely on 401ks and IRAs, where there's no program tweaking to keep pace with inflation. In addition, people nearing retirement usually shift their savings to bank certificates of deposit and bonds that don't have inflation safeguards. The good news, Social Security has a 5.9 cost of living adjustment increase that just kicked in, the highest in 4 decades. The 2022 COLA bumps an average monthly retirement benefit from $1,565 to $1,657, so about $100. Bad news, the 14.5 increase in Medicare Part B premiums for 2022 pushes the standard monthly premium from $148.50 in 2021 to $170 and 10 cents. And by some calculations, inflation has been higher than the headline figure of 7%. Well, that's not a surprise. The government changes how they do the CPI to make it look better. Inflation has probably been running much hotter the last decade or two, but when you pull out things like food and energy, you're not going to get a very accurate number. A new December CPI data indicates that inflation through December was actually 7.8%, a full 1.9 percentage points more than the COLA, said Mary Johnson, Social Security and Medicare policy analyst for the Senior Citizens League. What does that mean? On average, the retiree benefit increased by $92.80. However, current inflation of 7.8% means one's benefit would theoretically need to have increased by $122 to be keeping up, Johnson said, a shortfall of about $29.72. Grounds for a Medicare refund. Meanwhile, the Social Security Administration will be automatically deducting the largest Medicare Part B premium increase dollar-wise in program history, which would further reduce the amount of the COLA that people have to meet other significant price increases, Johnson said. Medicare beneficiaries may, however, have grounds to ask for a refund on a portion of their 2022 Part B premiums. It appears that Medicare is overcharging 57 million older disabled beneficiaries for their Part B coverage this year, Johnson added. The issue spurring the bump up in 2022 premium is Adalimumab, the contagious drug approved in June by the U.S. Food and Drug Administration for the treatment of Alzheimer's disease. Medicare usually covers FDA-approved drugs, but this one comes in with a stunning price tag set by its maker, Biogen, at $56,000 per patient annually. Holy crap! The drug will be covered under Part B rather than the Part D prescription drug plan. About half of the increase has been attributed to the drug, according to Johnson. The likelihood that many, Medicare patients will be prescribed Adulam in 2022 is very low. She said Medicare should lower the Part B premium, perhaps as much as $11.60 per month. All consumers are struggling with high inflation, she said, and an extra $11 per month might, for example, cover a copay on a needed prescription drug actually being taken by a Medicare beneficiary. So that's an interesting piece of news. So you might look for a refund on your some of your Medicare premiums. All right. Well, that's everything I had for today. If anyone needs anything from me, don't hesitate to shoot me an email or drop a phone call. I'll be back tomorrow with the weekly wrap up. And everyone, have a fantastic evening. Bye-bye.